anything hugely successful is generally the result of what we call a long tail event, an outlying 1 in thousands or 1 in a million event. And it really comes as a result of trying over and over and over again and failing. Hey folks, Colin Richards here. I'm president and founder of Lord & Richards, and once again, I'm thrilled to be with you on another exciting episode of Lord & Richards Radio. You know, in this episode and the next few, we're going to be talking about one of the most exciting concepts that we've unveiled at Lord & Richards and something that's really taken off with our clients. It's simple, easy to understand, easy to implement, and will help you retire financially independent. And that's what we do at Lord & Richards. Every day we're seeing people just like you who are concerned about events out of your control that might mess up your retirement. And so what we do is help you build a comprehensive financial plan so you can retire without worry and do amazing things with the resources God has entrusted to you. And so today we're going to do a deeper dive into this concept of the barbell. And I have to give credit where credit is due. I first read about this particular illustration financially in Morgan Housel's book, The Psychology of Money. After having had the chance to hear him speak and being impressed with his ideas, I picked up a copy of his book. And I've got to say, as he looks at the psychology and strategy of those who are most versus least successful financially, it really is helpful to pick up that book. I'd really encourage you to do it. But I'm drilling into one of his many concepts today, and that is of the barbell. It's something we've been doing at Lord & Richards for a very long time, but we have not used the barbell illustration historically. Well, let's start first of all with why a barbell might make sense to you. And a barbell is simply taking your assets and positioning them one way on this side of the barbell and another way on this side of the barbell. And thinking of your bar as kind of a liquidity meter in between. And so we're going to go into that a little bit further in a couple of segments. But first I want to talk to you about why this is so important. Because one of the things that happens a lot of times when I sit down with people, particularly if they haven't really heard our show or had the opportunity to be educated through our YouTube videos, which are videos of this show, as well as our podcasts, then they may come in with some preconceived ideas about what it takes to become financially independent in retirement. And I've got to say, there is a right way and a wrong way. This is not one of those where there's many, many roads to success. There is a right way and a wrong way. Now, that doesn't mean that everybody does it. It just means that some people actually get a little bit lucky doing it the wrong way. But for starters, what often happens is people have gotten used to maybe an advisor or they themselves focusing on stock picking as a primary strategy leading into retirement. And there's nothing wrong with picking stocks. There's nothing wrong with having a healthy knowledge about all the companies in your portfolio, focusing on those that you really know and investing in that way. Nothing wrong with that. But if you want to have a secure retirement, it's going to be a different approach that's going to get you there than stock picking. The problem with stock picking is you run inordinate risks. Let me explain with a couple of great illustrations that I borrowed from Morgan. The first is of a man named Heinz Bergrin, who fled Nazi Germany back in 1936. And Heinz, by the 1990s, was one of the most successful art dealers of all time. In the year 2000, he sold part of his massive collection of Picassos and other amazing pieces of art to the German government for over 100 million euros. That's a lot of money. The private market value was over $1 billion, so it was really considered a donation. Imagine being so successful at picking great works of art. Now, you might think he got that way by always picking winners and that this guy was just the equivalent of a stock picker's dream, right? Well, that's not how it works. How do collectors become great? Well, Horizon Research did a project, and they say it's more than skill or luck. The great investors, and I'm quoting, bought vast quantities of art. A subset, a small part, turned out to be great investments, and they were held for a sufficiently long period of time, that's very important, not day trading, to allow the portfolio to return, the total return on all the art, to converge upon the return of the best elements in the portfolio. That's all that happens. Fascinating, isn't it? They're saying it's not because they picked out the greatest investments. It's not because they, were just personally gifted. It's that they bought a large enough quantity and held it for long enough that the portfolio return rose as a result of those parts of the portfolio that were performing best. Bergrin could have been wrong most of the time and still end up stupendously right. $1 billion, stupendously right. Think about Walt Disney. Most of us are much more familiar with Walt Disney. Disney's first studio went bankrupt. Most of his 400 early cartoons were short, they were loved by viewers, they were monstrously expensive, and financed at outrageous terms. In other words, bad deals for Walt Disney. But one movie, Snow White and the Seven Dwarfs, changed everything. It earned $8 million in the first 6 months of 1938. That's an enormous sum back then. It resulted in all of the debts being paid, key employees being retained, a new state-of-the-art studio, and celebrity status for Walt Disney, all because of just one. You see, anything hugely successful is generally the result of what we call a long tail event, an outlying 1 in thousands or 1 in a million event. And it really comes as a result of trying over and over and over again and failing. The problem is that this is a tough strategy if you're a retiree trying to make sure that you never run out of money before you run out of life. Finally, one more illustration. Venture capital firms work on this same principle. Correlation Ventures crunched the numbers for venture capital firms. These are firms that deploy money on a venture at greater risk. Out of more than 21,000 venture financings that were done from 2004 to 2014, 65% lost money. Only 2.5% made 10 to 20 times. 1% made greater than 20 times what they paid, and 0.5%, that's 100 out of 21,000, earned 50 times or more. In other words, this small subset drove all of the returns. And the way the venture capitalists did this, they didn't buy the needle, they bought the haystack. That's the concept I want you to get into your mind. Don't look for the needle. Buy the whole haystack and let those individual needles inside that are performing well raise the overall portfolio. Even larger public companies can fall into this. Most of you are familiar with the Russell 3000. If you are already successful as a company, that's when you get to be included in the index. That means you may be on the tail end of life. As a matter of fact, 40% of these companies lost at least 70% of their value after they entered the index. Isn't that extraordinary? Almost all the index's returns came from just 7% of the companies that outperformed. Folks, this is why we're going to need a barbell. We're going to have a portion of our money on this side of the barbell that is safe and secure. And I'm going to talk about that and how to build your own barbell in our next segment. But for now, I would love to visit with you. My team and I would love to sit down and chat, hear about your goals, your dreams, your values, and how we can help you become financially independent. It simply starts with a phone call.